So I suppose if we can start with you, Roger, how do you manage volatility as a quantifiable piece for your customers? How do you manage that volatility?
So the first thing is to understand that the rest of the equity investment world sees volatility as risk, and we see it as opportunity.
Right.
So we want volatility because what it means is the very good companies that we buy shares in or try to buy shares in, if the more volatile the shares are, the more likely we can get them at a cheap price.
Yep.
Okay, the reality is that we'd like it to be volatile until we buy, and then after we've bought, we don't want the volatility anymore, right? That'd be ideal. But that never happens. And so what we try and do is we try and build a portfolio of companies that are in different industries that all have similar characteristics with respect to their economics.
Yep.
They're all very high return on equity businesses. They have little or no debt. They have bright prospects for their services or their products, and they have bright prospects for intrinsic value growth. And what we've discovered is that our portfolio, and we'll see this later on when we look at the performance of the funds, the performance of our fund is less volatile than the overall market. It does better when the market goes down. It seems to do better when the market goes up as well, so far. What we're noticing though, and with respect to the switch from term deposits and cash and bonds into equities, you mentioned the four stocks, basically the four majors, four banks or three banks and Telstra, with the exception of NAB, not so much NAB. I think that's now spreading. We're seeing interest in stocks, and we look at the biggest companies we've got in our portfolio: Seek, the Reject Shop, Cochlear, and CSL. We've just bought Cochlear just the other day when the price plunged. What we've noticed is there is interest and there's increasing volume in those stocks as well. So it's moved beyond just the high dividend yielding stocks.
Before I move on to Steve about that, in terms of the volatility, do you advertise that fact to your potential investors, the fact that it's not as volatile? In other words, you haven't seen it. So
we aim for it. But the reality is in our industry there are people making all kinds of promises. We can't tell you what the performance of the fund is going to be in the short run. And volatility is really a short run phenomena. It's not something we care about over 10 years plus. When we look in 10 years time, when we look back over the fund, all we care about is that you started here and we're up here. Right? And our clients, when they look back 10 years, they're just going to care about how much they've got compared to how much they started with. They're not going to care about the volatility so much in the short run. So we try and see it as an opportunity. We don't advertise that it's less volatile. It just has been.
At the moment it's going so quickly. The idea that resources stocks are starting to perform better.
A year ago, in April 2012, we sold all of our mining services exposure.
Yep.
We had no mining services stocks after that. And in fact, they rallied towards the end of last year and early part of this year, and we decided not to participate in that. We didn't buy them even though they looked cheap. And what's actually happening is a big story, and it's not over yet. In fact, on my blog, I put up a video of the Carpenters singing "We've Only Just Begun," and it's a great song. And there's a
great song.
Yeah, it's a great song. But we only have begun. And what's actually happening is that China's demand for our materials, at best, is going to maintain steady state, in my belief, and at worst, it could fall off a cliff. And the reason why that's happening is because global growth hasn't emerged. It's not as strong. And what we saw is the iron ore price in Australia, but for 30 years before 2004, it traded between $10 and $20 a tonne. Okay, so this is just background. And then between 2004 and 2011, the iron ore price jumped from $20 a tonne to $187 a tonne. The response from Australian miners, massive. Dig it out of the ground as fast as you can, get as many cranes as you can, get as many people as you can, put them in the hole and dig this stuff out and sell it. And that supply response means that those mines, those projects that did commence, when that actually hits, we're going to have 2 Pilbaras of extra iron ore from next year onwards. And at the same time that China's saying, well, we've built enough buildings that no one wants, we've built enough roads no one drives on, we've built enough schools where there are no students, and we don't need that much iron ore anymore. What we want to do is transition our economy from a fixed asset investment to consumption-driven economy. That means they'll still demand some iron ore, but nowhere near the rate of growth that we saw previously. So there'll be a massive supply response at the same time there's a reduction in demand from China, and we're going to see massive layoffs in this sector.
I couldn't agree more. Must be hard to trade equities. I mean, it's in in that environment because of the
No,
uncertainty?
it's easy. You just don't buy the companies exposed to that.
Okay, so how's the portfolio performing?
Well, we're fortunate that we've done very, very well, and I think we've got a chart.
I hope we've got a chart
here.
that'll come
Hope
up.
The chart comes up soon.
There's the chart of your performance, and I think,
very good.
Roger, is it fair to say you're the guy on the top?
We're the guy at the top, and it's been going very, very well. And we talked earlier about volatility, and you'll notice the Montgomery Private Fund's performance is actually less volatile than the market, which is underneath. And we've achieved that by, since April last year, not being in any resources or mining services, and owning businesses where they're reporting very significant growth in profits.
We're going to talk about one of those in a second.
Yeah, we are going to talk about one of those.
The thing that I'm curious, what sort of numbers are we looking at there, Roger? What sort of return is it that you're getting, and compared to the broader index?
So for the Montgomery Private Fund, in the 2 years to March, we've returned over 35% in that time, and the market's generated about a 10% return in that time, or a 9% return in that time. So we're outperforming by a very significant margin.
And what's the feedback like? How do you get that out to the broader market to talk about that story, other than talking to me? Because everyone
talk
watches
to you.
me,
That's about it.
I'm clearly, a lot of people follow me. But
the private fund only opens occasionally. It's actually been closed for about 8-9 months. And now we believe that there are going to be some opportunities in the market, and so we've just reopened the private fund again, the Montgomery Private Fund, and so we've got a lot of inquiry. People wait for an opening, and we send them an email to let them know that the fund's opened again, and they join at that time.
So one of the things I wanted to bring up and talk about was one of the assets that you own, which is Silver Chef.
Sure.
So
great business.
It's a great business. It is, and the reason why I know it's a great business is because we at FIG did their first ever bond issue. They did a 6-year bond issue, and it produced an 8.25% return. Now, one of the things that Silver Chef were looking to achieve, and I'm going to show a chart that I think underlines the achievement, the success, was if we can go back to the equity price of Silver Chef, we can show you that at the very bottom, this is a Bloomberg chart, so not the Silver Chef progression, that's the one. If you look there in the first large bar, at the bottom line it says 912. That was when we announced the fixed income offering. And what that did was, when we talked to our investors, a lot of them said, I've been watching this share, I've been looking at this company.
Well, we saw you do the bonds, we bought the stock.
Yeah, and that's what happened. Yeah. It clearly was a great thing for the company, because they were able to access a whole range of different investors who were able to understand a bit more about the business. You were able to roadshow those clients, and they were able to get out. How many companies would be trying to get out on and getting a message out? There are thousands of them. And the Fin Review didn't really want to look at everyone, but being the first people to stimulate the corporate bond market meant they got a lot more press. And you can see the effect on the equity price. And if you can show the bond, I want to show you the performance of the bond, which gives me the theme that you buy both. Roger, I know you only buy one, but
we only buy one.
Both.
Well, our mandate only lets us buy one.
We can change that mandate soon, I'm sure.
I think we need to put
Jane, if you could bring up the other one, that would show the performance of the Silver Chef.
It's a great story. Yeah, it's a great story. We should explain to people what the company does.
Would you care to do that?
They provide funding. They provide funding for restaurants and cafes to buy the equipment to set up. They have two businesses. They have the Silver Chef business, which does that, and then they have what's called the Go Getter business, and the Go Getter business is a bit more competitive, there's a bit more competition, but they basically provide financing for other equipment, other business equipment. Now you might think, gee, that's very dodgy, that cafes are going out of business all the time. Well, in actual fact, if you look at the American Express statistics and the Visa statistics, what you find is that since the GFC, restaurants and cafes have been booming. They're the one sector that has done absolutely brilliantly.
Absolutely. It's a $3 coffee.
And what they do is they basically offer financing, so you can either rent the equipment then buy it at the end, or you can go into a finance package and then you can transition after 12 months to rent the equipment, or you can buy it then. You can do a whole bunch of things. But only one of every 10 gets handed back, and then they have to go and sell it. And they sell 80%. They sell 80% all of the stuff that's returned. They sell it within 3 months. It's a small company. It's only the largest holdings that we have when we initiate a position in the fund, the largest holding would be about 7.5%. This is about a 2.5% position for us. But to give you some idea, the hospitality rental income has grown from 2007, it was $29 million. It's now $95 million of revenue. And then in 2008, the Go-Getter business started with about $2 million of revenue. It's now $65 million of revenue since 2007. So it's just phenomenal growth. It's a small company. A lot of people haven't heard of it, but it's been going very, very well. It's a great little business.
We're going to have a speed round, and we're going to start with Roger. The speed round is the Speaker's Corner. Roger will be on 6 and he'll be talking as of now.
So what I'd like to talk about is the Australian dollar. With the AAA rating, high material and resource exports, and very good credit rating, high interest rates, we've seen the Australian dollar very strong. But what's happening now is we're seeing a deterioration in competition. Our manufacturing is now dying. It's fallen by 40% of the economy and 20% in the last 2 years. And I think if the RBA doesn't do something to lower the Australian dollar, we're all in very big trouble.
Well done. But what we want to do is we start with Roger in terms of the Aussie.
You know, tourism stuffed. We've got a problem in retailing in Australia. You've seen some big names, Darryl Lee, you've seen Allen's Music, you've seen the demise of some iconic brands in Australia. And this is all because the Australian dollar has been so persistently strong. Now what's interesting is 3 weeks ago the IMF came out and they said we're going to start individually reporting Australian dollar and Canadian dollar reserves, and then the Aussie dollar started to come off. And I really think the Australian dollar is now at a point where we might see the end of some industries, particularly in manufacturing in this country. We'll never see them return. So we really are in a point, and we know what's happening in resources. In the next 24 months, we're going to see a lot of people out of a job in the resources sector. And what's the RBA going to do? They're going to see unemployment start to lift, and they're going to have to get that Australian dollar down.
Yeah, and I think it's through the I think it's through the interest rates. That's the only thing. They either get really radical with the interest rates, but if you're in the car sector, it would be very, very challenging to work out what the future looks like. If we know
what the future looks like. The future looks like no manufacturing of cars in Australia.
Yeah, absolutely.